now. Type it, yeah.
Hi everyone, my name is Tanya. I'm one of the regional managers for Australian Catholic Super. I'm based in Canberra. My office is on the ground floor in the St Christopher's Pastoral Centre in Monica. Our topic today is one of my favourites, retirement planning. The reason I say this is because I've seen how much of a positive impact super can have on people's retirement and their lives. So even if retirement isn't imminent for you, it's still important to pay attention to your super and to understand the role it can play in what we hope is an enjoyable retirement. Joining me today are my colleagues Phil Johnson, one of our financial planners, and Justin Colley, who will be monitoring the chat box and join us at the end if we have time for questions and answers. We might also try to answer them as we go through. So if you do have any questions, please enter them in the Q&A box down the bottom of the screen. Just so that you're aware, the presentation will be streamed live on Facebook and there'll be a recording available on our YouTube channel tomorrow if you'd like to share a copy of this presentation with any of your friends and family. In the spirit of reconciliation, I'd like to acknowledge the traditional custodians of Ngunnawal country, the land on which I work and live, and I recognise their continuing connection to land, water and community. I pay respect to elders past, present and emerging. Before we begin, please note that any information we provide in this presentation is general in nature. It's designed to illustrate what you can do, not necessarily what you should do. So please don't take any action based on this information before considering how it applies to your own personal circumstances, situation, objectives or needs. And always make sure you read the product disclosure statement and target market determination before you make any investments, and consider seeking financial advice to determine your best course of action. At Australian Catholic Super, we have our own team of financial planners who can help. And Phil.
Tanya.
How are you today?
Very good. How are you?
Yeah, I'm very well, thanks. Phil, retirement goals. I mean, for me, this is one of the fun parts of retirement planning, dreaming, thinking about the kind of lifestyle you like to enjoy. What do you consider as important when helping members at this stage of retirement planning?
Thanks very much, Tanya. Good evening, everybody. Yes, so what's in great slide to start with, because we'd like to start talking about retirement and what are the goals of retirement. What are you going to do in your retirement? What would you like to do in your retirement? We've put a few of those things up on this slide, be it travel, cruises, theatre, gardening, spending time with family, looking after grandchildren, all the things that people want to do in their retirement. We like to start to talk about this whole subject by asking simply, like you said, what is it you would like to do? And we can, once we have started to get an idea of this, then we can start to talk about the financial side of and implications of what your goals might be.
Yes, because I was going to say that, everything comes at a cost, doesn't it? And I guess it depends on the type of lifestyle you're used to. For me, I like going camping, but, not everyone's really into that. So there would be some kind of financial aspect to things.
Exactly, although I'm not sure about camping today in Canberra with the temperature, but, and Sydney for that matter.
So how much super do you have? Well, why is it important to know how much super you have? First and foremost, because it's your money and forms an important part of your future. And we're really keen for our members to become really engaged in their super. I think that's one of the keys to success. I think you should keep on top of what your employer is paying. Imagine if your employer forgot to pay you your salary. Well, by the same token, you want to make sure they're paying the right amount into your super. And currently the minimum superannuation guarantee rate is 10% for all adult employees earning $450 or more per month. You should work out if you want to add more to your super. You really should be looking at this every year and set yourself some financial goals. Maybe ask yourself, Am I going to focus on putting some extra money into super this year? And also ask yourself, how is my super invested? And what insurance do I have in my super? And is this insurance enough for the worst case scenario? Or even, do I need this insurance? It's also a really great idea to keep up to date with what the super caps are each year, so you know how much super should be going into your account and whether or not you'll go over the caps. And we're going to talk about superannuation contribution caps later on in this presentation. And for those of us who are starting to focus on retirement, it's good to know how much super you have so that you can see how you're tracking towards your retirement goals. It also really helps with some decision making for other aspects of your life. For example, if you've, potentially offered, a new job, or the impact of taking time off work, whether that could be to look after elderly parents or to raise children. Do you have enough money to live the kind of life you want in retirement? Well, that's one of those questions that we often get asked. Bill, can you talk us through this next slide and the relevance to anyone thinking about retirement?
Yeah, thanks. Thanks, Tanya. Yeah, so when we start to talk about all those goals that people have and how much they might cost and how much money they might need to live on, quite often people aren't sure. They've never retired before. So yeah. This is a helpful slide, and we, as financial plans, we use this as a starting point quite often to discuss with clients, because this slide talks about a what's called an ASFA standard. ASFA is the Society of Superannuation Funds in Australia, and they do surveys of how much money they think or people tell them they need to have in their retirement. And we find it a useful starting point in a discussion, particularly if you're not really sure how much money you might need. Look, just to give you an idea, what ASFA do is they categorize two different lifestyles or two different amounts of spending. You can have a modest lifestyle or a comfortable lifestyle, and they give you a figure of what they believe is the average for those expenditures for both. So for instance, the modest, as you can see on the slide, for a single person is about $29,000, and a couple is about close to $42,000 per year. And if you can afford or would like to have a more comfortable lifestyle, then the ASFA figures are correspondingly about $46,000 for a single and about getting close to $64,500 for a couple. So they're guidelines, averages that can be a useful starting point for a discussion. Now, the other thing I would like to point out to everybody is that this also starts to introduce this concept of, as well, how can I, whatever lifestyle, whatever living cost I do have, how can I fund it? And that's why on the left-hand side of the screen, we've also put up what is the amount of money that the full age pension can provide somebody if they are eligible. And you can see, for instance, a single person, it's about $26,000 per year is the full age pension. Now, the point where I'm trying to raise with everybody here is this: assuming that you had a modest lifestyle as a single person, then the middle box there tells you that that person needs about 29. If you were to get the age pension and you got the full amount, that would give you about 25. There's a gap, isn't there? There's a gap of about $4,000. So the government, just the concept we're trying to talk about at the moment is the government might be helping to fund some of your retirement, and your money might be required, your personal money might be required to fill the gap with the rest. And that's the kind of concept we're trying to introduce here.
Right. Now we've got a question come in on the chat box, and it's just a quick question about age pension, because I know we're going to do a little bit later on, but one of our guests tonight has asked, can you get the pension if you retire overseas? Bill?
Potentially, but it's that's a complicated answer. I think that would probably be better if we took that one offline.
Okay.
It is possible, yes.
Yeah.
Yes.
Okay. We'll keep moving through the slides and you know, talk a little bit more about pension later on. But those figures, some of the things that really pop out to me is, well, one thing that I can't help but asking is what does a modest lifestyle actually look like? What does a comfortable lifestyle actually look like? So I'll pop the next slide up on the screen.
Great question.
Yeah.
I don't know. I don't know whether I can actually read it because I'm having trouble reading it, to be honest with you. So it's a bit small. But what we're trying to tell you is this ASPA organisation, they do try to give you a bit of a guideline of what is a comfortable lifestyle, or what is so you can try to see which sort of person you might actually be, sort of thing. So without going right through that slide, I mean, you might be able to see from the top row of the slide, it talks about a comfortable retirement, someone having one holiday in Australia, and then it compares that to someone that's on a modest retirement, and it says 1 or 2 short breaks in Australia near where you live. So so it's just trying to break it down a little bit, but for you. But of course, it's not the sort of thing that you can look at it exactly, I think is the word. It's to give you a sense of that of what kind of expenditure you are. So you can actually go onto the ASPA website and you can actually see this information, and it can be quite helpful to help. Once again, it's a good starting point to give you a bit of a feel for where you might sit.
Okay. Fantastic, thanks, Phil. Okay, well, what are some of the sources for funding in retirement? So we're obviously talking about super today, but where else can people pull from?
That's
help with their retirement?
That's right. There's a few others listed here, isn't there? Obviously, we are going to spend quite a bit of time talking about super for because it's a very useful tool, and also obviously being a super fund, you would kind of expect us to talk about that. But yeah, I mean, when people come to see me, they may have other assets they may be going to use to fund their retirement. It might be money in the bank. Sometimes they might have some shares. Sometimes people have investment property, or they might be going to sell a property, or they, well, there you go. Next, family home. That what we're trying to say there is, sometimes people are downsizing to help fund their home, their retirement. Sorry, and of course, lastly, but not by no means least important, is obviously, and superannuation usually forms a big part of their retirement plans as well.
Thank you. And that's something that you talk to your clients about, I suppose, when you're just getting all of their details and their information, helping them work all of that out. Okay, so zeroing back in on super, what are some of the tax benefits of investing within super for retirement, as opposed to some of those other things that you were talking about?
Yeah, that's right. So why is what makes super such an attractive investment, and why has the government set it up this way to as a tool to help fund people's retirement? Well, one of the big advantages that superannuation has compared to most other investments outside of the superannuation system is the tax benefits. Superannuation generally will pay up to maximum of 15% tax on what it earns. If you compare that to most investments outside of super, your income is then subject to marginal tax rate system. And the point we're trying to make here is that if super is only taxed at a maximum of 15% tax, then that is generally lower than the tax they would pay on their marginal tax rate, which varies from person to person. But for a lot of people that are in the workforce, they're paying somewhere in the order of somewhere between 30 and 40% tax on their earnings. So superannuation, because you're paying less tax on it, that means more money left in the investment, therefore helps it helps it to grow faster than other forms of investment. That's what we're trying to say there too. We're going to talk a little bit more in this presentation about what happens when you retire with your super, but just to give you a heads up early now, and it's on this slide on the right hand side in particular, if you turn your money into a pension later on in life when you retire, then those pension products, they actually don't pay any tax on earnings. So you've now got a completely tax-free investment. That's an exceptionally attractive investment from a tax point of view, very hard to beat in terms of tax and paying no tax.
Yeah, I certainly like the sound of that. I think the key message we're trying to get across during this webinar is really to let people know that the final resting place for your super could be this fantastic nil tax pension account. But the trick is, how do we get money into super in the lead up to retirement to put as much as we can into that nil tax pension environment? We're going to talk about that, but also, you know, the next slide. Why are these ages important when it comes to super? Because we're busy thinking about generating and earning and paying off mortgages and, you know, putting money into super. What's this all about?
So this particular slide is actually starting to talk about access to your super, in that I think most people generally know this idea that the government doesn't really want you to have access to your super until you're you're retiring, because that's its purpose, to fund your retirement. But there's actually your access to super varies as these particular age groups that we've got up here on this screen. Your access to super changes over time into these particular ages. So what it's trying to say in broad terms is, look, people who have between 58 and 59 who may have met what's called their preservation age, which generally speaking means the age the government will let you start to access some of your super. 58 to 59, you may start to have some access to your super, but it may, I guess the main thing I'd like to say there is, it may still be subject to tax on payments from it, or drawing money out of it may still have tax implications. But when you get to 60, if you are actually able to access your super at that point, then the withdrawals from the superannuation are actually tax-free. If you take that even further, when you get to age 65, in terms of access to your super, you can actually still be working and access your super at 65. So we just go back to the middle age, 60 to 64. If you've retired, yep, sure, the government will let you access your super. If, on the other hand, you haven't, you can't access your super, well, not fully. So you've kind of got some restricted access at these earlier ages, but at age 65, in simple terms, you've got full access whether you're working or not. That's the best way of simply saying it.
Okay. It can be a little bit complicated, I guess, if you're not used to those rules, and that's where we hear from. So it depends on your circumstances, depends on your age.
Exactly.
But the great message there is, once you get to the age of 65, you know, you're free to run.
You can do what you like.
All right. Okay, so we've talked about the tax benefits of saving into super and that great zero tax pension environment. So now we're going to have a look at ways to grow your super and build it up before retirement. Phil, a lot of people talk about salary sacrifice. Why is salary sacrifice a popular method of building up super?
So salary sacrificing some of your pre-tax salary into superannuation has the effect of reducing your taxable income, and therefore can potentially mean you pay less tax. That's the overall principle of it. And a little bit more detail on that is sort of given on by reference to the marginal tax rates in the slide that you're seeing in front of you. So I don't know, for instance, if you see there are people earning between 45,000 and 120,000, their marginal tax rate is 32.5%. So if you take some of that salary and salary sacrifice to super, you don't pay 32.5% tax on that anymore. Now it gets a bit more complicated, as we're about to see in the next kind of slide, but I think that's what we need to establish at this point. So
right, so rather than paying tax on it and it landing in your bank account, rather than paying your full marginal tax rate before it gets in your bank account and then going from your bank account into super, you're saying salary sacrifice might be a bit more tax effective.
Exactly.
Let's have a look at this next slide where there's an example. Well, that one there.
So this is trying to give everyone a little simple worked example of how someone could benefit from a salary sacrifice strategy. First point to note is salary sacrifice contributions are taxed at 15% when the money goes into the super fund. So salary sacrifice is potentially very good, but it does actually attract a tax. It's a contributions tax on the money when it goes into the super fund. However, as you can see from hopefully we'll go through the example, you can see that the overall net benefit to you is greater than the 15% tax. Anyway, let's have a look at the example quickly. So in this particular example, this person is earning $100,000 a year, which turns out to be $3,846 per fortnight. We're comparing what happens if they, on the left-hand side, they don't salary sacrifice with what happens if they do salary sacrifice on the right-hand side. So, so this person, they originally not make any salary sacrifice, but then on the right-hand side, you can see they salary sacrifice 5% of their salary, $192. Their taxable income falls from $3,846 per fortnight to $3,653. What impact does that have on take-home pay? Yes, they do get slightly less take-home pay, don't they? They're getting $127 less, but they do actually, because their taxable income has fallen, they do pay $66 per fortnight less in tax, which turns out to be $1,716 per year over 10 years. 17,160, and that whole point about why are we telling you about what it is over multiple time periods, because superannuation is one of those long-term kind of investments. You do it a long time. $66 per fortnight in itself doesn't sound like, that's not going to make a big difference, but you do it long enough and it does make a big difference. And of course, once you put that money into super, that money's invested and also increasing because of the effect of compounding interest. So there's a tax benefit. You save less, pay less tax, and also your money goes into superannuation and continues to help build up your retirement.
Fantastic. Okay. Bill, can you take us through? So salary sacrifice is a concessional contribution.
Yes.
We talked about that. What are some of the things that fall under this type of contribution? What's the limits? How does that work?
Yes. So salaries, as you said, Tanya, salary sacrifice is a form of what's called a concessional contribution. There's two types of contributions to super. One's called concessional, the other one's called non-concessional, two basic types. Concessional contributions, such as salary sacrifice, there's a limit of $27,500 per year. What does it include? Well, it includes salary sacrifice that we've just been talking about, but there's a few other things listed there that it also includes. So the money that your employer puts into super, it's called the superannuation guarantee, that's also a concessional contribution. You can make lump sum contributions to super, which you can claim as a tax deduction. That's also counted towards this $27,500 concessional contribution limit. And the thing we're just trying to alert everybody to is that don't think of, if you salary sacrifice, you've got to take into consideration in terms what the limit is, and when you take into consideration what the limit is, you've got to take these other types of contributions that you may not directly be making, such as your superannuation guarantee. They all form part of the limit. That's what we're trying to tell you.
Right. Yes, I know that a lot of people say to me, Tanya, how much can I salary sacrifice? And I say, well, you know, first we need to think about what you can afford, but then we also need to look at the cap is 27,500 and deduct from that your superannuation guarantee, and that gives you the gap.
Exactly. Very good.
Right. Okay. Fantastic. This next slide really talks about, once again, the concessional contribution, that is superannuation guarantee, which we all get that if we're working, which is fantastic. So the superannuation guarantee rate will be increasing from where it is now at 10% of your gross salary per annum until it reaches 12% on the 1st of July 2025. And why is this? Well, the reason is because we're living longer, which means you'll be retired for longer, and we need our super to last the distance. And because of this risk of outliving our retirement savings, the government has legislated these increases to assist with funding our retirement, but also so that we rely less on the government pension. Now, remember that government pension singles rate is about 25,000 each year. It's not a lot to rely on. So the whole idea of super is to help become self-funded if you can, and to hopefully have a bit more of a nicer retirement, a nicer lifestyle. So that's the government's way of saying we acknowledge what's happening, and we are legislating this, so we're making it a rule to assist people along the way. And that is particularly helpful for those who can't afford to actually add their own money to super. Non-concessional contributions. So this is the other type, the opposite of concessional. Why are they called concessional and non-concessional? What does that mean?
Well, I guess you're claiming one claims a tax concession and one doesn't claim a tax
Right.
concessions. This idea about tax concessions, yeah, that's or deduction. Sometimes they're actually called deductible and non-deductible, aren't they? So it's yes, that's basically what it's referring to. This someone is claiming with a concessional contribution, someone is claiming a tax deduction for the contribution. That's right. Whereas with a non-concessional contribution, no one is claiming a tax deduction, and anyway, subject to a different set of rules.
Where does this money come from? Where do people usually get these large sums of money if they can, you know?
Well, sometimes they've saved it.
Yep.
But you know, they might have inherited money.
Okay.
You know, they might have sold an investment property. It takes the form of however it got there, money that's it's worked its way into the bank.
Okay.
You know, so once it's in, you know, just say generally speaking, a lot of people have money in the bank that they want to put into super, and so anyway, there's a different set of rules and different set of limits, and I guess we've got a bit of explaining to do here, Tanya, because the government is going to change the rules in about 2 weeks' time from the 1st of July. So this slide's going to tell you what the current rules are. That's what we want to know. So at the moment, but non-concessional contributions, they do have a limit of $110,000 per year, and if you are under 67, you can also make use of something called the bring forward rule, which in simple terms means that you can actually make up to 3 years worth of contributions in a single year. It says it on the slide, you know, if the limits per year is 110, 3 times that's 330. So you can put put a lot of money in pretty quickly under this bring forward rule. So that's that bit explained, I think. Then you talking about in that middle slide, it's saying, well, you know, if you're between 67 and 74 at the moment, you can still put money into super as a non-concessional contribution, but at the moment you have to meet what's called a work test. in order to be able to do that. And you can't use the bring forward rule like you can when you're younger than that. And then 75 and over, you can't make any personal contributions into super.
Yeah, I think we might not focus too much longer on this slide because the rules are about to change, and we kind of cover that in a couple of slides time. But in my view, the change is excellent. But I'll see what you think, Phil.
Okay. Of course, I love it.
Okay. Other ways to contribute, Phil. Can you just briefly touch on the downsizer and spouse contributions?
Just brief, because there's a lot to cover here. But downsizer contribution, if you at the moment under current rules, if you are over 65 and you sell your home, a few eligibility rules, but the main one is it's got to be in your home for more than 10 years. You can put up to $300,000 each into super. And I emphasize the word each because obviously that means I'm trying to convey the point that a couple could potentially be doing the two of them, put in 600,000. A lot of money.
Yeah.
Spouse contributions, I won't focus too much on those, but yes, it's another type of contribution. It's a non-concessional, it's a form of non-concessional contribution. Might move on from that one for the moment. And of course, there's consolidation of super, which is what is not actually a contribution, is it?
No, it is. And you know, this is really interesting because one of our guests tonight has asked about consolidating super. The question is, if you have two super funds, is it best to put it all into one or be paid by two super funds? Well, like all of these questions, the answer is it depends. Yep. But what I do have to say about consolidation is you know, one of the ways to help manage your super is to consider consolidating multiple accounts into one, just purely from that point of view. It's all in one place, it's easy to keep track on, and it may help you save on fees. But it's before you do anything like that, it is really important to understand the features and benefits that come with each of your super accounts, because they could be different. And if you're closing one account, you want to make sure that you're not inadvertently cancelling some really important features. For example, you might have insurance cover in one super account that you may be unable to get elsewhere because you've got health issues. So we really encourage people, before they do make any moves to consolidate multiple super accounts into one, is that you check the details before doing anything, okay? So yes, it depends. You could save on fees, it would be easier to manage, but some people on purpose have multiple super accounts. So that's something that you know, we can help you understand more if you want to get in touch and have a consultation with us. Okay, the exciting stuff. Here's what's changing from 1st of July 2022. I think the exciting stuff's on the next slide, but here's just a little bit of history.
I'll just quickly mention these ones, but as you say, probably the next slide's the one we want to get to. We're going to talk about allocated pensions, probably in about 5 minutes time, but government's going to reduce the pension, the minimum amount of money that you can draw down from an account-based pension. We'll talk about that a bit more when we come to that slide. Superannuation guarantee, basically, I don't think that's probably going to have too much impact on most people listening tonight, but the idea is that people that are earning less than $450, I think, per month, the employer didn't have to pay the employer payment. But from
I think that really impacts a lot of young Australians.
Yeah, exactly.
Maybe multiple casual jobs, and the employer,
well, that's right. I mean, good news for my son that works at KFC. But not too sure how many people work at KFC tonight. Thank you, Tanya.
Yes.
Okay, so here's what they're changing. Now, I've just told you that you're on the previous 2 slides back that if you're between 67 and 74, you have to meet this work test if you want to make a non-concessional contribution to super. Well, the good news is for non-concessional contributions, they're going to abolish that. So no work test. So you don't have to do any work to be able to put the money into super. For non-concessional, I want to emphasize that.
Okay.
If you do make a lump sum concessional contribution, you still got to meet the work test. So, but anyway, I've said it, but and something definitely worth speaking to advisors about if that's what you're contemplating doing. Yeah, so that's that one. So the work test will be removed from the 1st of July. The bring forward rule, which I said was only available to people under 67. So that's going to be increased so that you can still do that up to age 75. So remember, the bring forward rule was that one where you could do 3 years worth of contributions, the 330,000. So that's another big one. And the downsizer contribution, which I said for people over 65, if they sell their house at home, they could put in $300,000. Well, that one's actually, they're going to reduce that age requirement down to 60. So another big change there as well. Again, won't focus on the last one too much. Retirement planning seminar. I'm not too sure many people are going to be buying their first home, but yes, there's been some changes so that first home buyers can access more money in their super to buy their home.
Phil, just really quickly, why do you think those first 3 dot points are exciting for Australia, older Australians? What's the reason behind these new rules?
Well, it's enabling people to be able potentially to put more money into the superannuation system in broad terms. And by being able to do that, you're able to potentially put more money into that, these very low tax or tax-free earnings environments, which have not been open to people to be able to do at these ages. So it's not necessarily going to be something that's obviously applicable to everybody, but it's certainly going to open up more opportunities for I'm suspecting a reasonable number of people.
Yeah, and I think also those ages as well sort of tend to coincide with people that do receive inheritances and do.
Yes, very good point.
Yes, they're a little bit more in keeping with what's happening at the moment. Okay, we'll keep moving along. All right. We've talked about ways to grow your super and build it up before retirement through these various contributions. Phil, can you please take us through when someone can access their super and under what circumstances? This is almost like going back to what we were talking about.
Yeah, that's right. I sort of generally spoke about this probably about 10 slides ago, so I won't spend too much time on it again, but this idea that being able to access your super, it relates to this concept of preservation age. So in broad terms, you're not going to get access to your super until you've met generally speaking, you're generally not going to be able to get access to your super until you reach your preservation age. And the preservation age is slowly going up to age 60 at the moment, and what age your personal preservation age is depends on your date of birth, and that's what the slide is demonstrating to you. Okay, I think I said it at the previous slide, but if you have met your preservation age and you haven't retired, so say you leave a job with one employer and go and get a job with another employer, that can be grounds to be able to access your super as well. The technical term, which is written there for me, is called condition of release. If you meet a condition of release, you've got access to your super and you can potentially turn it into a pension. So you're going to be able to do that certainly if you've met your preservation age and retired, but another condition of release is that you've left one employer, joined another one without actually retiring, if you're over 60.
Yeah, so there's 2 gateways, isn't there? There's the meet the preservation age is the first one. Once you've ticked that one, then you've got to go to the next column, condition of release, and it's either one of those 2.
Yeah, that's right. And I just noticed down the bottom of the slide as well, it's emphasising as well, isn't it, that at age 65, it doesn't matter, you've met a condition of release, and it doesn't matter whether you've retired or not, you can still get access. There's
some benefits for turning 65. So we've talked about when you can access your super, but Phil, can you please explain how someone can access their super?
Yeah. So, I mean, in broad terms, there's two ways. You can either take your money as a lump sum, or you can turn it into some sort of regular income, or as it's called, an income stream. Now, most people, they're looking for a regular income in retirement. And so they generally don't want to take all their retirement savings out in one lump sum. And so income streams, pensions, as we're about to talk about, are often very attractive to lots of clients.
I might just quickly slip in a question that came through, sort of kind of relates to this slide as well. One of our guests has said, is money saved better placed in super or left in the bank considering market fluctuations? And I guess the same could be thought about, with once you've retired, should you take all the money out and put it in the bank, or should you leave it invested in this super? That's another one, another question with an answer that says it depends.
Thank you, Tanya. I was about to say, it kind of depends, doesn't it? I mean, but in broad terms, positives and negatives, very, how do you say that in 20 seconds? Look, money in the bank, generally speaking, doesn't earn very much. It's very secure. But and yes, interest rates may be starting to go up, but we've been from historic lows, so you have a lot of your retirement savings invested in a very low environment. You may not even be keeping up with the rate of inflation with your investment. Money invested in superannuation has a number of different investment options that you could put it in. But if you went for some sort of strategy to try to help fund the long-term growth of your, or long-term maintain your retirement savings, let's call it that, then yes, I mean, it's going to be subject to probably some sort of risk and market volatility. But we tend to think about super as a long-term investment, and so history has shown that whilst there's lots of volatility and there's lots of things going on in the world, particularly at the moment, but history has shown longer term that having a longer term investment and exposing to some level of risk can potentially can work out a good means of maintaining your wealth to last your lifetime. That's what you're trying to do, generally speaking. Yeah,
and I know that it can be daunting for people who aren't experienced investors to make decisions like this, and this is where we can help. We do offer financial advice at no additional cost around this very topic, money in the bank versus investing it into super, and if so, what type of option. We'll talk about that a little bit down the track, but we've got one more question before I let you go to the next slide. It's going to be covered in the next couple of slides anyway, but the question is, can you take your super as both a part lump sum and also a continuing stream? And the answer is yes. That was a yes and no.
I thought you were going to say it depends, but yeah, we both agree it's kind of yes, isn't it?
It's a yes. We're going to talk about that in the next couple of slides. Okay. All right, Phil. In the last slide, you introduced the idea of income streams. What's the difference between a super account and a pension account?
Yeah. Okay. So the super account is what most people have when they're working and they are putting money into the superannuation. You're contributing. We talked about those concessional and non-concessional. You're building it up. You're building up your retirement savings. Main points are that I think we've probably already said it 10 times today already, but money is generally speaking locked in there until you meet some sort of condition of release, and the earnings on the investment are taxed at a maximum of 15%. But then when you are able to, when you retire or when you meet a condition of release, you can potentially turn your money into a pension, and now you're no longer contributing. You're actually drawing money out of your superannuation money in the form of a pension. And as Tanya actually said, to the question about drawing the lump sums, you can start a pension and get a regular payment, and you can also take lump sums out of it if you need to, and that's not uncommon with clients. A lot of flexibility there. Regardless of all that, the earnings on the investment are tax-free.
Okay, I'm going to keep zooming along because in the interest of time.
Yep.
Quick, brief chat about transition to retirement.
Yep.
Please, Phil.
Yep. So transition to retirement pensions are a form of these income stream. It's just they are one that you can start before you potentially have retired. So you might still be working, and the government will give you some access to your super in the form of one of these transition to retirement pensions, but they won't give you full access. You're allowed to take a maximum of 10% of the account balance out as a pension payment in a year. They don't have the same tax benefits of these account-based pensions that we've been talking about when people retire. They still pay 15% tax. However, that's exactly the same as what your superannuation pays. So it's not worse than paying. The tax position is identical to your super, but it has given you some limited access to your super. And you minimum payment you must take, but the tax on the earnings, sorry, the tax, if you draw money out of one of these transition to retirement pensions, if you are over 60, there is no tax. That's in a summary.
Okay.
Quick summary.
Okay. Okay, we're going to have a look at how an allocated pension is different to a TTR pension. This is that lovely tax-free final, we've worked, we're there, we're retiring, we're enjoying our retirement. What's happening here, Phil?
Yeah, that's right. So some of the things I've kind of a little bit repetitive here, but these allocated pensions or account-based pensions, you must take a minimum payment. How much is the minimum payment? It depends on your age. For instance, a 65-year-old, the normal minimum payment is 5%. It says there, first point of the slide says, oh, well, it's actually been reduced. So it's actually at the moment only 2.5% is what you've actually got to take out. And that will apply for the next financial year. It's only a temporary measure because of the COVID. So we don't expect it will last beyond 2022-23, but we actually don't know at the moment. There's no maximum. So those transition retirement pensions, you've got to take, or can't take more than 10% of pension out. But with the account-based pension, you can take out what you like, basically. Of course, you've got to be careful there because you spend too much, you run out of money. So it's so yes, you've got access to it, but you obviously got to be careful with it as well. Like I said, with the transition to retirement pension, they are tax-free if you draw any money out of them after 60. And if you need to take a lump sum, as I've already mentioned, you can take a lump sum out of them as well, in addition to your pension payment. Right.
A lot of people come to see us when they're at that point, and they ask questions like, how regularly can I take money out? And I always suggest that maybe, to start off with, you might want to replicate what you've been getting as a salary. So if you're used to being paid fortnightly or monthly, then perhaps, and then some people are in the fortunate position where they just want to receive that tax benefit on the interest of the money, but they don't really want the pension. So for them, they're still going to have to take at least a minimum.
That's right, and that's where the financial planning comes into it. Like, well, hey, you've got a tax benefit. How much tax will you save? And and what do you do if you don't need the money? Potentially, you can put it back into super. Potentially,
right.
So
Interesting. Okay, all right. RetireChoice is the name of our product. Phil, would you mind just taking us through this?
Yeah, so we're still on this subject of these allocated pensions, and what we're talking to you now about is that Australian Catholic Super have two allocated pension products. One is this one called RetireChoice, and the other one is called RetireSmart that we're going to talk about in a second as well. But the RetireChoice, the basic idea is this: you invest your money in one of these pensions, and you have the ability to choose the investment strategy based on your individual preferences and circumstances. I'm talking about the level of risk in the investment and the sort of returns you're trying to get. You can adjust it. You've got choice. That's what it's talking about. And there are the choices. There they are. So I think there's 13 different options available in Australian Catholic Super, and you can have one of those or a mix of those in the investment. And once I say you can tailor it to try to match what the investment choice to match your individual preferences in relation to how much risk and return you're trying to get.
Fabulous. There's also this one, RetireSmart. Who is this good for, do you think?
I think this is good for people who want something that's probably, it's not, I like to describe it as set and forget a little bit. RetireChoice, you're actually making some active choices about how you want your money invested, right? RetireSmart, the fund is kind of making those decisions for you. So it's not as tailored as the RetireChoice. But it kind of runs itself a little bit more than the RetireChoice. Yeah, I mean, it goes on to talk about how does it work, and the basic idea. Thank you, Tanya. The basic idea is that the fund will put a certain amount of money in what they call a growth. I'll call it a growth bucket or growth circle on the slide, and that's sort of to fund, that money's there to help fund long-term growth in the investment, right? And then you've got this smaller bucket of cash, and that's where your pension payments come from. And what the fund is doing automatically on your behalf is they're managing those two buckets so that you've got enough money moving between the buckets. So for instance, you take your pension payments out of the cash bucket, it needs to be topped back up, and so that money comes out of the out of the growth bucket. But the fund is automatically doing that for you, and that's why I say it's more of a set and forget kind of strategy.
Okay, thank you. Thank you for talking through the products. I think the next section, what we're going to talk about is how financial planning can help. So for me, I think one of the most valuable things that financial planning can do for the members that I talk to is help you understand when you can afford to retire and how long your money will last, and throw into the mix unexpected events like COVID, which we've seen has really had an impact on many people's lives. But thankfully, financial planning can factor in some contingency plans to account for the unexpected. And over the next couple of slides, we'll show you an example of financial projections you might receive in a financial plan. Phil, these slides are all for you. If you could please take us through them and let me know when you're ready to go to the next slide.
Oh, thank you, Tanya. Okay, so yeah, we're just going to give you a little example of how we, when we're writing advice for clients, trying to talk to them about can they afford to retire, how long will their money last, all these big questions that are really important when you retire. We use software to help model your situation. So we're just trying to give you a little example here. These people, 65 years old, they both have $300,000 in their super. They own their own home. They need about $63,000 a year to live on. I mean, they're the main assumptions, but the modelling does pick up other things like the rate of makes assumptions about the rate of inflation, what the return on your super might be, and things like that. So maybe we will go to the next slide, Tanya. Thank you. And so this graph actually looks pretty simple, but it's actually a lot thousands of calculations have actually gone into this, where it basically shows that in the case of this particular couple, you can see on the right-hand axis, there they are. They have their $600,000 at 65 to $300,000 each. The home is not shown on this graph because we're not you need somewhere to live, so we don't count that in this this example as being something you would use to be funding your retirement with. So these people, they got the $600,000, and as you can see, the money slowly does run down, but they get to 93 on this particular graph. So they don't run out of money until 93. Very long time, and this graph actually surprises quite a lot of people who don't think, oh, $600,000, is it really going to last to 93? How is that possible? And I think the answer is probably coming up very shortly on the next slide, where you look at what's going on with the income that they receive. The simplest way I can explain this graph is that there's a red line running along the top of that graph. That is the $65,000 a year these people need to live on. Okay, and then below that is a purple bars and there is blue bars. And the purple bars are basically money that they are drawing out of allocated pensions in this particular case, or their superannuation. But hopefully, as you can see, after the first year, and when they reach the age pension age, they start to receive money from the government in the form of the age pension, and that's what the blue bars are. And you can see early on in the graph that the blue bars slowly increase over a number of years and then plateau off. And that's because the age pension is means tested. And slowly, as their assets go down, they start getting more age pension until they reach the maximum age pension. And so anyway, to summarize, what I'm trying to tell everybody tonight is that the age pension actually subsidised these people quite a lot, and therefore their $600,000 lasted much longer than what they might have thought initially as a result of receiving the age pension.
Right, okay. No, that's great. Speaking of age pension, I have to we either have to hurry up or we have to excuse ourselves. It looks like we might run over time, but let's see how we go with this age pension. Phil, if you could take us through these next few slides. Yeah,
okay. So again, we'll just very quickly, there's a number of things that are looked at for the age pension. One is your age. You've got to be old enough to start. You've got to be an Australian resident, and they're going to look at your assets and income. That's basically, I think, what we need to know there.
Great. Fantastic. And what about the ages?
Yeah, and I think again, for the sake of time, I think people will broadly understand that as time goes by, the age at which you can receive the age pension is slowly going up, and come the 1st of July 2023, it'll be age 67 for everybody.
Okay, next couple of slides, we'll look at the assets and the income test. We do a singles and we do a couples. I think I might just go past the single and we'll talk about couple.
Yeah, and again, I think it's probably more important we just talk about the concept, so much the numbers. Okay. What we're trying to show everybody here is that, for example, a couple homeowner, if they have assets of less than $405,000, then they may be eligible under the asset test for a full age pension, and if their assets go over $901,500, they wouldn't get any age pension under the asset test. So that blue area in the middle, you'll get some part pension. That's the concept we're trying to talk about there.
Right. And then for the income test, Yep.
Yeah, similar concept. If you're earning, again, single person, for example, on the top of the slide, $180 per fortnight. If you earn less than that, you would get the full age pension under the income test. But if your income was over $2,155 per fortnight, you wouldn't get anything under the income test. And once again, that blue area there is some form of part pension that you might get. And I guess what's not really on the slide, but I just like to say, because I think it's important, is that what Centrelink actually do with the age pension is they actually calculate an age pension based on the asset and the income test. They compare the two pension figures, whichever one is the lower is the one they apply to you.
Right. So if you're not really earning any income, but your assets are too high, there'll be no age pension.
That's right, because you would have failed the asset test, even though you passed the income test.
Gotcha. Okay. Thank you. And let's have a bit of a look at the maximum age pension and how that compares as a single and a couple.
Yep. So we touched on it, I think, one of the early slides, but single person, the maximum you can get is about $26,000. Whereas for a couple, the maximum for the couple is about $39,000. So you don't just, a couple doesn't just simply get double what a single person is. I think that's the point we're trying to make there on the slide, unless you're on the far right-hand side of the screen, you're actually separated due to ill health.
Really, really important question that's come through, and one that's we know off by heart, but we didn't actually mention. Does the asset test include your own home?
Yeah. Sorry about that. Yes. No, it doesn't.
Right.
No, it doesn't. That's a bit, you're right. Very important. It doesn't include
Very
your
important. So you could be living in a $5 million mansion and still potentially be eligible for some Centrelink Age Pension.
Absolutely.
Wow. Okay. Wow. Okay. Great. Moving on a little bit, we have the Commonwealth Seniors Health Card. Phil, if you could take us through this one, please.
Yep. So if you are not eligible for the age pension, you failed the means test, but you've met the age requirement, you may still be eligible for a Commonwealth Seniors Health Card. It doesn't have an asset test. It only has an income test, and the income test is probably, I would say, more generous than the test for the age pension. The figures are quoted for how much income are you allowed to have. It's about $57,000 for the single and about $92,000 as a couple. Too complicated to talk about right in today's seminar, but the way that what they class as income is a subject in itself that you could seek advice about.
Okay, thank you. So what else? Seniors cards. These are great ones. So they're available from your local, state and territory government, and there may be slightly different rules for each region. So please check with your state or territory government in which you reside. Just really quickly, Phil, can you please talk us about some of the other topics that you can help our members with? I'm going to flick to the next slide as well, because that one. Yep.
So estate planning is actually very important. We can assist clients to some extent with it, but we would also say to people, you should speak to a solicitor about things like wills and power of attorney, things that are, you're making sure that when you pass away, how will your assets pass to your relatives, and other things that we can advise on. Going really quickly, we can give some advice in relation to aged care. And that may be could be for yourself, but quite often it might be for relatives. Yep. So I've probably covered off most of these things already tonight, but this is just a slide where it's talking about what sort of things can a financial planner help you with. But I hope you've got a sense tonight that we can help you with, talking to you about funding your retirement. Can I afford to retire? All those sorts of things. Help you maximise your Centrelink or your age pension entitlements and things like this. Estate planning. Money, we don't have to provide advice just in relation to superannuation, although it has been the focus today. We also take into consideration other investments outside of superannuation. And also, I think it's important that people know that we do also advise people, or can potentially advise people who are not members of Australian Catholic Super. So, for instance, one member of a couple is a member of Australian Catholic Super, the other's not. We can still potentially look at that situation as a couple. That's what we're trying to say.
Fantastic, thank you. So how can we help? Well, you can talk to your regional manager, like me. Our job is to deliver personalised service and information to our members. You can also contact our helpline team by calling 1300 658 776. Phil, we've talked a little bit about comprehensive advice. How about limited advice?
Yep. So sort of just to make it clear to people, there's a few different types of advice that the fund's offered. I'm what's called a comprehensive advisor, and I talked about some of those things that we can advise on. But there is also what's called a limited advice service. Now it's phone based. So most of what I do is generally face-to-face, or thanks to COVID, Zoom. But this limited service is basically over the phone. It is free. Actually, I shouldn't say it's free. It's of no cost to no additional cost to the member, I think is the correct terminology. So it doesn't cost you anything extra. But the range of things they can talk about is limited. But they can talk about things which, for a lot of people are, the things they want to talk about. Contributing to Australian Catholic Super. How should I invest my money in Australian Catholic Super? What about my insurance in Australian Catholic Super? Can I start a transition to retirement pension in Australian Catholic Super? All those sorts of things can be addressed to some extent, at least, in limited advice.
It's certainly one thing that I do recommend to a lot of the members that I meet with face-to-face, and probably the most common topic is how to invest my money. And I certainly encourage everybody to get in touch and make an appointment for one of those sessions, because as Phil mentioned, it comes at no additional cost. This next slide, Phil, potentially a little bit of repetition for what we've had before. You happy for me to just gloss over that one?
I think we've covered that, Tanya.
Yes, great. Okay. It's also important to know that we offer a member portal where you can track your super. It's just like online banking, and it's easy to register if you haven't already. That's like a little bit of a preview of what it looks like when you jump online. And a couple of other things, you can transact on the account once you're in the portal. For example, you can change your investment options. A lot of my members really enjoy logging in and having a look to see how things are going on a regular basis. So what can I do right now? Well, it's certainly time to take some action. Definitely recommended that you register and log into the member portal so you can start keeping track of your super, and so you can start having a look and see what your money's up to. Speak to your regional manager. We're now able to offer face-to-face meetings in our regional offices, and we have 2 offices in Sydney, 1 in Brisbane, 1 in Canberra, 1 in Townsville, 1 in Port Macquarie, and 1 in Perth. We also suggest you book an appointment to talk to one of our financial advice team. You can call us, you can email us, you can visit us in the local office. And following this session, you will receive a survey where you can elect to have one of our regional managers contact you over the next few days, if you like, and if you'd like to continue the discussion face-to-face. I think we've answered all of the questions that have come through. Been having a look at the chat box and the Q&A. And that is the end of our session. We've gone a little bit over time, but thank you so much for everybody who's stuck with us. Thank you, Phil, for your input.
Tanya. Pleasure.
And thank you to everybody.